We start today's market talk. Uh, it's such a blessing that amid all the murder and mayhem, we have a president who ensures that the red line of 4.5% yield on the US 10-year Treasury note is never crossed. So, these are the minor things which are keeping things normal because Trump is sensitive to US 10-year Treasury yield, viewing it as a real time scorecard for his economic policies due to due to its impact on equities, housing market, and government costs to service the national debt. So this is the only thing which is not letting the situation go out of hand. Rest, he is not bothered about. I don't think he's bothered about anything else. And so, if you can see here, this is a US 10-year yield. Uh, it went up to around 4.5, and then the whole narrative of de-escalation starts. So once it comes down a bit, then again the escalation starts, and this is the one which is keeping uh, things normal. And the reason is very simple because they have to retire debt and they have to take on fresh debt. It's a regular process for all the countries. And then if the fresh debt is at a higher level, then the cost of borrowing goes up, and then the interest cost in the budget goes up, and that creates a different kind of a problem in terms of government spending and all those things. And this is the only reason why uh, these yields become very sensitive, and these yields are not bothered with the narrative or whatever you say, because this is what people are ready to pay for the risk they are taking to invest in 10-year government bonds, 10-year US government bonds. So they are not ready to accept less risk, and higher risk means higher interest cost. So this is the reason the yields go up. Now, market outlook signal from global bond markets is that they expect the energy shock to drive up inflation faster in countries outside the US. So all over the world, the bond markets are showing higher yields because of high dependence on West Asia fuel. It, it raises the vulnerability to higher fuel prices and higher inflation. Limited supplier diversification also weakens resilience. So these are some of the reasons why that if the yields are going up. So if you see here, this is US 2-year yield. It has already touched 4. Then the Indian government bond yields, it crossed that declining trend line. So now it is heading to 7. And this trigger took place, basic trigger, though it was going up slowly, the basic trigger took place on Friday when the government reduced the excise duties on fuel. So what is happening is that the government finances or the fiscal deficit will be much higher. Government will have to borrow more, so the cost of money is going up because the money available to rest of the people to borrow would be limited. So people are expecting higher interest rates. So this is the reason. Now, India's fragile energy architecture has been exposed. Why it has got exposed? Because there is limited supplier diversification, which has weakened the resilience. Strategic reserves are insufficient. Renewable energy lacks storage and grid support. Strategic petroleum reserves cover about 9 to 10 days of crude oil demand, and no buffer exists for LPG. And that's why the crisis is very big in terms of India. And then Goldman Sachs and HSBC have forecasted significant cuts to India's consensus earnings over the next 2 to 3 quarters amid expectations that crude oil prices will remain elevated. It's very simple mathematics. $10 rise in crude prices lowers the India's GDP by 0.4 to 0.5 percentage. Simple. So if the rise is from $60 to $100 is the base price, that is $40, you can straight away take out 2% from the India's GDP growth. So the projected MSCI India's earnings growth for equities uh, has been reduced to 8% for calendar year 26 and around 13% for calendar year 27, and that is also too far. So GDP growth forecast has been lowered. CPI forecast has been increased. That is, consumer price inflation has been is expected to go up by at least 1% to 2%. Current account deficit to 2% of the GDP, which is leading to weaker rupee. And so people are anticipating now, instead of rate cuts, at least 50 basis point of rate hike in 2026. So if you see the same action after the bond yields is in the rupee, it is touching 95 now. So it is on a declining trajectory, and that trajectory has got accelerated now with this conflict. But I think there should be some pullback with these RBI actions now. But the trajectory remains on a declining path. So it is being accelerated because of higher current account deficit, and FI is pulling out money, and the FDI is pulling out money, etc. From India. Now coming to FIDI data, FIs have built up very strong short positions. Say on Friday, they have added big short positions in both Nifty and Bank Nifty. So they are short in index futures in Nifty and Bank Nifty. They sold calls and bought puts in index options, so they are strongly bearish. And this is just one day before the expiry. So there would be that is tomorrow, would be a very, very interesting day. Now, pros, and they are selling in, FIs are also selling in cash. They have, I think, sold around 1.25 lakh crore in March alone. Pros are having long positions in index futures, but bigger than that, they have sold calls and bought puts in index options, so they are medium term bearish. Clients have long positions in index futures. They have bought calls and they have sold puts in index options, so they are strongly bullish. So right now, the positions are extreme. So now I'll show you the data for the whole week. So if you see here, the movements have been big. So if you see, it is not all movements, big movements are 2% plus. And on those days, FIs have done big selling in futures and in options also. So you see 3% move, which took place on 19th March, then on 23rd March. So they have, and then on 27th March, that is on Friday, they sold big time in index futures. So the trend is very clear, and they have been selling. So see, from 26th February onwards, they have been selling continuously in cash markets, though it has been absorbed by the DIs. But this is what is leading to fall in the rupee also. Now coming to US markets, US dollar index is touching 100, and that is leading to decline in all commodities, all emerging market currencies, etc. This is reflecting, along with rising treasury yields, this is reflecting shifting expectations around monetary policy, because this is a normal thing. As dollar is a safe haven, everybody wants dollar so that they can do their imports when the crude prices are higher. So, and also in the rising US yields, etc. So this is a reflection of that. Brent crude is touching that 120 level. This was the same level it had touched uh, during the during the during the crisis of 2022, when the Ukraine and Russia war started. So we have reached the same level. Any further escalation will take it to 150 or odd level, but right now it has reached that level. So the degree of fear is the same, or the demand supply gap is the same. It is overbought, but it can remain in this position for very long. Uh, it will remain higher till the time the Strait of Hormuz remains closed. Now, gold, it's an interesting thing. People thought that gold is a hedge against uncertainty, but in uncertain times, people have booked profits, and I think some central banks are also selling because they need money to fund various activities, and their earnings are reduced. But it is stabilizing at around 4,400 odd. So it this is a daily chart. So if you see here, it took support at the 200 EMA gold. So that is roughly at around 4200. So anytime it comes here or at these levels, very gradually one can keep building up your positions in gold, uh, and it rebounded after the negotiations and all started. Similarly, with silver, it is at now firmly below the $70 level, the last support, and now it is facing resistance here. So may go down to 50, etc. in case the negotiations break down. Copper is correcting uh, in spite of bullish outlook, etc. because people are expecting lower demand, lower economic activity, etc. So that's why it is correcting. Bitcoin again corrected due to strong dollar and higher interest rates expectations. It can crash easily to the 60,000 level where it last time it went and went up from there. Now coming to US indices, they all corrected. Uh, Pressure was maximum in Nasdaq. It has come to the bottom end of the rising channel. Due to higher valuations in AI sector, it is getting cut. S&P 500, this is a weekly chart. It declined around 2%. It is heading to this support, which is at 6,200, uh, which was from where it started moving after the Trump presidency started. And Dow Jones corrected around 1%, and it has come down to all the that support level of 45,000 odd, and erased all gains of Trump's presidency. So we are back to the levels from which people started before Mr. Trump became president. Now coming to Indian markets, see India VIX again went up. It was declining. This is a daily chart. So Monday it went up, 2 days it declined, and on Friday again it went up to around 26, 27 level. So right now it is peak fear. So one should be careful right now, because if the uncertainty goes up more, it will go up further high, and till the time the VIX is high, you will see big gap ups and gap downs. So don't be surprised by wild movements in a day, etc., because that kind of thing can always happen. Now, if you see Nifty on the weekly chart, it made a doji. Last 2 weeks it has been making doji, but still lower lows and lower highs, and the trend is downwards. So what it is indicate is market is not certain, etc. But it is not, and it is making wild moves during the week because of news flow. But clearly the support is, it is heading to 22,000 level. It has plunged around 9% this month, and FIs I have told you have sold around 1.27 lakh crore. Uh, Short-lived pullbacks last two to three trading sessions. See, as we saw, it went down on Monday, then pull back for two trading sessions, then sharp drawdown. Highlight the fragile sentiment right now. This is the hourly chart. So if you see in very short term, this 22 500 odd level, the last low is, it should be a support, and this 23,050 odd should be a resistance in the very short term. It should operate within this range. But if this 22 500 breaks, then we would probably head much lower. So one should be careful, and then it will go to that support of 22,000 and maybe 21,800, etc. The reason for fall is Nifty Bank. It has been declining. It fell around 2% last week, and it made a bearish candle. It, even on weekly chart, it is now nearly getting oversold. It is underperforming. So if you see here, the daily chart, the support is at around 51,500 and 53,300. This area, this area should be the high of the Friday, should be the immediate resistance. So 53,300 and 51,500. But if once it goes down, so if you see here, once it goes down from here, then it will head to this 48,000 level, because there is no support. It is just going down with strong momentum. So because banks are expected to bear the maximum brunt of this higher interest rates, weakness in the economy, etc. So there would be lower lending, higher NPAs, all those issues. So the bigger decline is coming in HDFC Bank, which is taking both indices down. It is grossly oversold now. So if you see here, but my recommendation is that seeing the negative news now, it is better to play safe and not try to buy the dip. It can easily go down to this support which it had to around 700. That time one can think of buying it, because that should provide a decent support, because that was the level from which the rally started. So right now it is a falling knife. Now Reliance was holding the market till last week, and now on Friday, because of higher duties on exports, Reliance also fell. So it fell. Most of the selling took place on Friday only. So that is the one which took the Nifty down. So on Friday, if you see, Nifty and Nifty Bank were clearly sells, led by Reliance and HDFC Bank. Reliance support should be at around 1300. The stock which is holding up is L&T. It came down to the lows around 3300 and then has bounced, but it has met some resistance here. So let's see if it can take out this 3500, 3600 levels, then can support the market. Otherwise, it will also head down to this 3200 or the lows it makes made last time. Now, in this mayhem, the mid caps, if you see here, mid caps didn't fall much last week, and small caps also. So they are small cap took support at the 15,000 level support for the small cap index. They are holding up slightly better, so showing relative outperformance. Maybe also because Nifty and Nifty Bank are being sold by FIs. So I'll cover now two stocks. First is Uno Minda. No, it's a leading auto component player since 1958, uh, and has a leadership across key product segments. Well diversified product portfolio with marquee clientele both globally and domestically. Diversified product division, acoustics, switches, castings, lightings, and others for both four-wheelers and two-wheelers, and geographies, international and domestic, channels, replacement, and OEM. Product portfolio is well insulated from any foreseeable market disruptions with an ICE oblique EV agnostic product portfolio also, and constantly increasing kit value. That is the amount of money they're getting from every vehicle, leading to higher wallet share with OEMs. So they are generally doing well in terms of their performance. So if you see, these are their segments: lighting, switches, acoustics, castings, aftermarket, others, and seating. So if you see the last quarter results, they did around 20% year-on-year growth, 20%, 21% EBITDA growth, and profit growth was 28%. And for 9 months also, they did around 25% profit growth. So they are uh, well diversified and a decent business which is not dependent only on one segment of the vehicles. So if you see division wise revenue fix, so generally similar, it's similar from Q3 FY25 to Q3 FY26. So their main segments are switches, lightings, and castings, with seatings, acoustics are smaller ones, and other segments around the same time. So these are the three segments from which they get the maximum revenues. So if you see the revenue growth, switches, lighting, castings has been the same, 25, 23, 19%. And they are making new plants, etc. Expansion in Farukh Nagar, four-wheeler lighting plant in Indonesia, recently commissioned capacity expansion in both AW four-wheeler. AW four-wheeler is alloy wheel four-wheeler. Alloy wheel is basically, as you would know, combination of aluminum and magnesium mixed with other metals. So it makes the wheel slightly lighter and more flexible. and alloy wheel two-wheeler also. Aluminum prices have increased, so that should be a problem for them. So they have announced a greenfield plant with 18 lakh per annum capacity for alloy wheel four-wheelers. Uh, Similarly, in acoustics, again, they are maintaining the same similar ratio and seatings and others, that is sensors and ADAS, advanced driver assistance systems, basically parking assistance, collision avoidance, driver monitoring, vision systems, etc. So they are doing well in even this system, and EV systems record healthy growth driven by e-three-wheeler charger business. So you see in their EV product portfolio for two-wheeler and three-wheelers, they have got multiple products which are required for e-vehicles. A potential kit value for EV two-wheeler existing ICE is around 11,936 internal consumption combustion engine. It for EV it is roughly 37,600 plus. So the net revenue which is generated per vehicle is higher. Similarly, for four wheelers also they have certain important components where the orders have been won or they are doing some kind of a development. So it's a strong and well diversified performance in Q3 FY26 with growth across all key segments. It's aggressively expanding its alloy wheel capacity with a new 764 crore facility in Maharashtra, target 18 lakh wheels per year. EV powertrain construction is progressing on a new greenfield facility of high voltage EV powertrain components required for electric SUVs and commercial trucks under joint venture with Innovance. It has entered the premium PV sunroof market with a technology licensing agreement with Japan's Aisin Corporation. The company is setting up an 81,000 units per year facility in Haryana, capex 60 crore, expected to be commissioned by Q4 FY27. Manufactures CNG and LPG kits, directly benefiting from sharp rise in CNG adoption, gaining from mandated acoustic vehicle alerting systems in EVs. Long-term growth potential as a play in auto sector driven by new product introductions, premiumization trends, ongoing capacity building to meet industry demand, and a strong EV order book. Capacity expansion projects, benefits from which are expected to materialize in Q4 FY26 and beyond, further support growth. Expect a revenue EBITDA PAT CAGR of around 18, 20, and 29% over the next 3 years. So if you see here, they are expected to do around 22,928 crores of revenue in FY27 with a PAT of roughly around 1544 crores. So say even if we take 1,500 crore and 2,000 crore PAT in FY28, taking a mean of around 1,800, they are presently at around 60,500 crore market cap. So that means they are at around 30-35 times forward earnings. So it has valuations have come down with decent sales growth, 17-18%. Operating margins are improving. ROE is above 20%, improving, and strong EPS growth, etc. So EPS growth of around 20 to 30%, which is decent. Now this stock has corrected from the highs of 1400 odd and has come down to around right now it is at around 1048. It made a low at around 1000 odd, which should be a decent opportunity to buy this stock for as an investment purpose. And on every dip from here there, if 1000 breaks, then it will head to this 900 or 870 odd levels where it last took a support, but this 900 level should be a decent support. The other stock is HFCL. It is undergoing a significant transformation, evolving from a telecom-focused EPC player into a diversified product-led defense and aerospace entity. Its order book stands at 11,125 crore as on Q3 FY26, shows business visibility over a medium term. It secured a long-term agreement worth approximately rupees 10,159 crore to supply optical fiber cables to a global municipal corporation. So that is in addition to the 11,000 crore of existing order book. The hyperscale data center expansion and AI infrastructure deployment are leading demand for higher fiber count, higher realization, and lower latency cables. It is supplying high density cables and passive connectivity solutions to global hyperscalers. So what it is able to achieve is achieving all three, which is higher fiber count, higher realization, and low latency cables require a shift from traditional optical engineering to high density multi-core AI optimized network architecture, and that is what they are able to do. Uh, this is they are shifting away from low margin EPC towards high margin OFC, defense, and solution based businesses, leading to 18 to 20% EBITDA margins going forward. The company repaid debt through QIP around 550 crore recently, which is expected to reduce interest costs going forward. HFCL Advanced Systems Private Limited debuted with a confirmed order book of 1680 crore, dominated by significant 1570 crore in export orders for aerostructures and aeronautics. The electronic fuses advanced trials are slated in April 26. Post approval, the company is targeting 1 lakh fuses, 20% of the market demand going forward. It has secured 329 acres with plans to expand to 1,000 acres in Andhra Pradesh for ammunition manufacturing. The products planned include multi-mode hand grenades already developed with DRDO, shells for 155 guns, and precision-guided munitions. Estimate revenue EBITDA PAT CAGR of around 19.9, 36, and 58% CAGR over the period of next 3 years. ROC, ROE is expected to improve from around 5 or 4% in FY25 to nearly double to 12 to 12.5 in FY28. The only thing which needs to be seen or risk is debt, and promoter pledging at HFCL requires close monitoring. So that has to be seen, because if the price goes down, then there would be margin calls to the promoter also. So if you see here, firstly the order book part, it was 11,125 crore at Q3. Then they got this on, I think, 13th March. They got this new global OFC deal, 10,000 crore. Defense consolidation, they got total orders of 1680. So total visibility is 22,963 crores uh, as of right now. So you'll have to take out whatever is executed in Q4. They do around 5,000 crore of revenue in a year. So roughly it gives them 4 years of visibility. So they have products across telecom, networking products, defense, electronic products, passive connectivity solutions, and wire harness portfolio, etc. So optical fiber cables, etc. So they are doing well. So if you see in Q3, they did around 19.6% year-on-year growth. The gross margin went up around 703 basis points, and EBITDA was up 51%. The PAT was up 40%. So significant improvement in the performance. PAT margin was also up. Uh, so if you see here, uh, they have increased their segmental revenues to telecom products. Earlier, they were more focused on turnkey contracts and services like EPC thing, that they have been constantly reducing every quarter from the peak, and increasing the products, because products are showing better, much better growth year on year versus EPC. And even Q and Q, the EPC is declining. And if you see the revenue mix also, telecom products revenue mix is increased now to roughly 60%, and EPC is around 40. The EBIT wise also, it is basically the EPC is loss making, and that is why they're getting out of this. And telecom products is the one which is driving the revenues and margins also. So it's at 28%, and EPC nobody is making money in India. So that's why they are also pivoting their business to telecom products and not into EPC businesses. Order book, as I told you, Q3 was 11,125 crores, with the mix of network services, operation and maintenance, and products is increasing roughly 41%. They are increasing the their order book to from government now to private. So earlier the government was the main one. So roughly more than 80% was government contracts or in terms of order book. That has come down to around 69.6% and private has increased. So which is positive because cash flow is a problem with government contracts. So if you see revenue is expected to grow around 19.9% CAGR. Softening of raw material costs will lead to improvement in gross margins. EBITDA and PAT levels have improved and return ratios are improving. So things are looking much better. What they are working on is to reduce their working capital days, inventory days, and creditor days, and also reducing their debtor days. So you see, the basic problem with most of these businesses is cash flows and high debt. So cash flow is improving right now. So that should be a positive because in FY24 they had negative cash flows and that led to decline in the performance. So if you see, they are expected to do around 5,500 crore revenue in FY27 with margin of around 16% improving and a PAT of roughly around 499 crore. So if you take this 500 crores, they are at around 10,300 crore market cap. So they are at 20 times, growing at 20x. So the PG is roughly, that's only revenue. The PAT is expected to, so if you see here, the profit growth is expected to be around 25% to 30%. So they are at PG below 1. So it is pretty attractive. Decent revenue growth, decent operating profit growth, margins are improving, ROC is improving. P is come to around 20 odd, and for if you take FY28 earnings, it should be lower, around 15. Debtor days are coming down, so that should be this thing, and interest coverage days are going up. That is basically, you have to see that the thing which you have to see is EBITDA and how much of interest expense is there per year. So if you see, EBITDA is much higher than interest expense, so that means they can service their debt. But the only thing which has to be kept in mind is that they have this is data as of Q3. Now they have taken see, as I told you, 10,300 crore market cap, and they have taken a order which is equivalent to their market cap. So how will they get working capital and all will have to be seen. So if you see here, the stock made a high of around 160 sometime in 2024. And after that, that is September, when there was a peak of enthusiasm in the Indian markets. And after that, it has been seeing a constant decline, made a low at 60. And the day it got that order also, it didn't really go up, went to 76. So wait for bad days to slowly accumulate this stock, and around 60 is then it becomes a very cheap stock to buy, but you can slowly accumulate this stock. Only thing is, you have to see how much they are borrowing, what is their cash flow position, and what is happening to the promoter pledging. But if the stock is brought down or it goes down more, then it goes down more because the market starts getting concerned about promoter pledging. And in a earlier market, a bullish market, a 10,000 crore order for a 10,000 crore market cap company, this would have been up 20%, right? But now, because of the situation and all, it just went up to the 77, 78, and then just came down. So this is a weekly chart, so that's why I'm showing you this. So one has to be careful, but it is now at support. So any dip is a buying opportunity. I finished. We'll take questions now.